Hey everyone, this is just a quick heads up that the autumn sale for Snowball Analytics is here with a massive 30% discount. Make sure to jump in early to get the best deals and don't wait too long because it ends soon. Be sure to use my unique link below to grab your discount and you can even renew your subscription at a lower price, so don't miss it. Hello and welcome back to the Geordie Pig Investor channel where we delve into the world of dividend investing to help you build a portfolio that pays you. Today we're diving into pets at home. And no, this isn't just an excuse to show off cute puppies, though I wouldn't blame you for hoping. The stock has been absolutely hammered lately, but that steep fall might actually be the perfect chance to scoop it up while it's on sale, because behind the market panic, the fundamentals are still wagging their tail. Pets at Home is a UK-based retail company that specialises in pet care products and services. It operates a nationwide chain of stores offering pet food, accessories, toys, bedding and healthcare items for a wide range of animals, including dogs, cats, small pets, fish, reptiles, you name it, they probably supply it. In addition to retail products, Pets at Home provides services such as grooming, veterinary care through its in-store Vets for Pets practices and pet adoption partnerships, making it a one-stop destination for pet owners. And if we have a closer look at some key stats to do with Pets at Home, we can see they're currently priced at £1.99, part of the consumer industry, have a market cap at 896 million, when public back in 2014 have over 8,000 current employees on a 4-year dividend growth streak. And then the important two stats that I love to see is a fantastic 5-year dividend growth rate at 11.63% and a dividend yield that now sits at a massive 6.53%. Over the last 12 months, Pets at Home is down 33.28%, and that's exactly why we are going to dive deeper into them in today's video. First of all, let's have a closer look at why Pets at Home is down in price. The first one being their profit guidance cut and profit warnings. Pets at Home has issued more than one profit warning this year. The latest is a cut in full year guidance for underlying pre-tax profit to about 90 to 100 million, down from earlier estimates of 110 to 120 million. This has affected the price because investors dislike surprises. When a company lowers its profit expectations, it suggests current performance or future demand is weaker than hoped. That tends to reduce confidence, increasing selling pressure. We then have the weak demand in the retail segment. The retail side is underperforming. Store sales are down about 5% year to date, and the demand for discretionary pet products has softened. The underlying pet retail market is being described as subdued, even slightly declining. This matters because the retail business is a big part of Pets at Home's revenue, so weakness here pulls down top line and margins and investor expectations. When consumers cut back on non-essentials due to tight budgets, retailers often get hit first. Then you have the rising costs and margin pressures. The company is facing higher costs such as labour increases with minimum wage going up, plus inflationary pressures. Also, investments in marketing are adding to cost burden. This matters because if costs are rising faster than revenue, it's going to hurt margin profits. And if they can't increase prices due to competition or customers' unwillingness, then profits can erode. Another potential recent downside is the CEO departure. Lisa McGowan, the current CEO, has left abruptly. Ian Burke has become interim executive chair while a permanent replacement is sought. This is important because leadership changes, especially sudden ones, typically spook investors. They raise questions about strategy continuity, executive risk, and future direction of the business. And finally, we have the macroeconomic pressures. The broader UK economic environment is constraining discretionary spending. Higher inflation and living costs squeeze consumers who may pull back on non-essential pet purchases. This matters because even if a company is well run, tough macro conditions can limit revenue growth and make cost pressures worse. Now we're going to have a closer look at why I think you should consider Pets at Home. Pets at Home have a strong brand and market position. They are one of the UK's leading pet suppliers and service retailers with wide geographic coverage and good name recognition. This gives it competitive advantages such as economies of scale in purchasing, strong customer loyalty, and multiple revenue streams. In consumer retail, having a trusted brand makes price sensitivity less of a liability and gives some buffer in challenging times versus smaller or less known competitors. They also have non-discretionary elements and recurring demand. At the end of the day, pets are always going to need food, veterinary care, and grooming, regardless of many other economic pressures. While discretionary pet accessories may suffer when consumers are squeezed, essentials and health services tend to hold up better. This provides revenue base that's more resilient during economic downturns or inflationary pressures, making them less volatile than wholly discretionary retail. And following on from that, you have the growth in ancillary services. Pets at Home has been investing in its veterinary business, grooming and pet insurance. These services often carry higher margins and recurring spend. If pet owners use them regularly, they tend to build recurring revenue streams. This helps because it diversifies revenue sources and can reduce risk, and these services tend to have better margins or more stable cash flows. And with this company, there is definitely the potential for margin recovery. If cost pressures ease, there is potential for margins to recover, especially if the company manages to improve operational efficiency and scales its services side further. Also, price increases can mitigate cost inflation. This helps because margin recovery often drives profit growth. We then have their undervalued expectations. Because of recent profit warnings and weaker retail performance, the market may be pricing in a pessimistic scenario. If Pets at Home can show credible signs of recovery, there may be scope for re-rating. Buying into a depressed valuation can offer higher upside if positive catalysts occur. I feel like the risk-reward ratio may be more favourable with a company like Pets at Home than a momentum stock. And finally, we have tailwinds from pet ownership trends. In many markets, ownerships of pets remain robust and pet humanization. This means that owners are spending more per pet and treating pets more like family. This continues to drive growth in premium foods, health services, grooming, and pet tech. Even in tighter economic times, many pet owners try to maintain pet welfare. We are now going to have a closer look at Pets at Home on Stockopedia. Stockopedia is like the Swiss Army knife for investors. It packs stock screening, financial data, charts, and expert analysis all into one easy-to-use platform. If you're interested in trying it out, then click my link in the description to receive a free 2-week trial alongside a massive 25% off any package. Stockopedia's quality, value, and momentum scores break down a stock's investment appeal from 3 angles, and we can see that Pets at Home scores very strongly on 2 out of 3 of these scores. As you can see, they have a very low momentum score, but I'm not worried about this one bit because I actually quite like to see low momentum scores, as this usually means a stock is trading at a cheaper price. Below these scores, we can see in a little more detail what metrics are being measured for growth and value. I love this breakdown as it shows you how the company compares against the industry, but then also against the market as a whole, which really starts to paint the picture. Another great feature is that it shows you how a company is performing when compared against the Piastri score, Altman Z score, and earnings manipulation score. For Pets at Home, it scores very well across the board. They tick 8 out of 9 of the boxes on the Piastri F score, meaning that it is in a very healthy position. And with the Altman Z score, we can see they have a safe bankruptcy risk. And then if we finally have a look at the earnings manipulation risk score, we can see that they actually tick 8 out of 8 boxes here, which puts the company at a very low risk, meaning that they don't have anything to hide within the company. In its most recent update, Pets at Home highlighted several encountering figures despite wider retail pressures. The vet group continued to shine, with consumer revenue up 7.1% year on year and like-for-like growth of 7.8%, leaving the division about 40% larger than it was 3 years ago. For fiscal year 2025, the group delivered an underlying pre-tax profit of roughly 133 million in line with expectations, while basic earnings per share climbed to 19 pence from 16.6. Cash generation also improved, with free cash flow rising 14.8 million to a total of 83.8 million, providing scope for reinvestment and dividends. Customer engagement also remained strong as the Pets Club loyalty scheme grew 5% to 8.2 million members, reinforcing the company's stable, recurring revenue base and long-term growth potential. When having a closer look at the analyst consensus, we can see that there were 2 sells, 2 holds, 2 buys, and 3 strong buys, which shows quite a mixed bag of opinions. However, if we have a look at the overall analyst forecast, we can see they have a price target of 257 pence, which is 33.7% above that current price. As I am a dividend growth investor, one of the main things I'm looking for within a company is for it to be showing consistent dividend growth. One way to see this is by looking at the company's payouts throughout the years to see if there's been raising that dividend payment on a year-to-year basis. And as we can see with the chart for Pets at Home, they have had a pretty solid growth chart, and as we mentioned earlier, they actually have a 5-year dividend CAGR of over 11% currently. I would also like to point out that they have a payout ratio of only 50%, so plenty of wiggle room if they do decide to continue increasing their dividend payment on a yearly basis. Now on to the exciting part of the video that you've probably all been waiting for. We've had a look at all of the information, gathered it together. So without further ado, let's crunch the numbers and see what I believe Pets at Home is valued at. First off, we're going to have a look at their intrinsic value. To work out the intrinsic value of a stock, I combine two key approaches: a discounted cash flow valuation and a relative valuation. With the DCF, I forecast the company's future cash flows, then discount them back to present value using a chosen discount rate to account for risk and time. This gives me a baseline value based on the business's own cash generating ability. I then cross-check that with a relative valuation, looking at how similar companies are priced using ratios like PE, EV to EBITDA or PFCF. By averaging the results from both methods, I get a more balanced and realistic estimate of what the stock is truly worth today, and when plugging in my numbers, we can see on the worst case scenario that Pets at Home is valued at 251.96 GBX, which would be a 21% undervaluation on the current price. On the average case, being valued at 310 GBX, which is a 36% undervaluation on the current price. And on my best case scenario, being valued at 443 GBX, which is a 55% undervaluation on the current price. I then use Wall Street estimates when analysing a company because they provide a broader market consensus on future earnings, revenue and cash flow expectations, usually based on detailed research from industry analysts with access to management insights and market data. These estimates help me stress test my own assumptions and see if my valuation is in line with or diverging from what the market is expecting. It also gives context around investor sentiment and potential catalysts or risks that may not be fully reflected in historical data alone. In short, they help validate or challenge my thesis with a wider lens. And as we can see on the lowest forecast, they believe there's still a potential downside of around 3%, being valued at 192 GBX. On the average forecast, having a forecast of a 46% upside, being valued at 287 GBX, and on the highest forecast, seeing a massive 97% upside, being valued at 388 GBX. Once I've calculated the intrinsic value using both my DCF and relative valuation methods and factored in Wall Street estimates for an added layer of insight, I combine all that to arrive at my final buy price. This gives me a well-rounded, evidence-based target that reflects both the company's true cash generating potential and how the broader market values similar businesses. I also apply a margin of safety to account for uncertainties or forecasting errors, so my final buy price isn't just a number, it's a point where I feel confident I'm getting long-term value with limited downside risk. For most companies that I value, I feel that it's a great value on the average case price with some margin of safety applied. And as we can see on the worst case scenario for Pets at Home, they are valued at £2.22, so with a 10% margin of safety, you'd be looking to buy the stock at £2. And with a 20% margin of safety, you'd be looking to buy the stock at £1.78. On the average case, they were valued at £2.99, so with a 10% margin of safety on this price, you'd be looking to buy the stock at £2.69. And with a 20% margin of safety, you'd be looking to buy them at £2.39. And then on the best case scenario, we can see they were valued at £4.16. So with a 10% margin of safety on this price, you'd be looking to buy the stock at £3.74. And with a 20% margin of safety, you'd be looking to buy Pets at Home for £3.32. So what does this mean? Is the stock a buy right now? In summary, I think Pets at Home is a strong UK dividend stock to buy now. Given its strong market position, resilient veterinary growth, and improving cash generation, Pets at Home appears to offer an attractive entry point for both value seekers and income investors. The recent share price weakness has left the stock trading at a discount to its long-term potential, yet the company continues to deliver solid underlying profits, rising free cash flows, and a growing 133 million earnings base. With its 7% plus vet group growth, expanding 8.2 million member loyalty program, and a well-covered dividend supported by 83.8 million free cash flow figures, Pets at Home combines defensive, recurring revenues with long-term pet care tailwinds, making it a compelling buy for investors looking for both recovery upside and reliable UK dividend income. And as we just highlighted on the worst case scenario, with a 10% margin of safety, they are sitting exactly at the buy price that it is right now. Thanks for watching the video. If you enjoyed this breakdown, don't forget to like and subscribe for more investing insights. Pets at Home might be in the doghouse with its share price right now, but for the patient investors, it could turn out to be the perfect addition to your portfolio. After all, even a stock needs a little bit of fetch before it's going to bring the returns home. If you enjoyed this breakdown, don't forget to hit the like button and subscribe for more stock insights. For now, this is the Geordie Pig Investor, over and out.